So Meta stock is down more than 70% for the year and fell below $100 yesterday after disappointing earnings. So again, why? In part 1 of the video, we said that the reason people are panic selling is because their revenue declined in the last quarter. Revenue has been declining for a couple of quarters. Well, actually for 2 quarters in the last 4 quarters, right? So revenue declining, number one. But not only that, but their expenses have been increasing consistently. Their expenses increased by 19%, their costs. So when revenue is flat or going down, expenses go up, what happens? Profit plunges. So their net income dropped more than 50%. So in part 1 of the video, I said that if these reasons are cyclical reasons, it means they're short-term reasons, no worries, right? The stock will bounce back, the company will continue to grow. When revenue re-accelerates and expenses come down, profits will go up again. But if they are secular, long-term, permanent reasons that revenue is not going to grow again, expenses are never going to come down, profits will keep going down, it's time to sell the stock. So in part 1 of the video, I focused on the revenue, and we saw that revenue went down for cyclical short-term reasons because of the strength of the US dollar, number one. So if you take away the strength of the US dollar in constant currency terms, their revenue actually went up, although at a lower rate. But the main reason for revenue dropping is because of an industry drop in advertising demand, because advertisers are cutting back because of a fear of a global slowdown and recession. So once confidence comes back, people spend more on advertising, US dollar moderates, their revenue will re-accelerate. At the same time, we saw that they have got a lot more additional revenue streams they are creating from WhatsApp and Messenger. And when Reels fully monetizes, then revenue is going to re-accelerate. So I'm pretty confident that their revenue is going to re-accelerate strongly in the next 12 to 16 months. Now, in this video, let's look at the other part of it. Yeah, so revenue can accelerate, but if their expenses are going up too much, their profits will keep going down. So let's take a closer look at their expenses. What's happening over there? So you can see now these are year-on-year figures, right? So again, you can see revenue for the last couple of years have been growing 55 billion, 70 billion, 85 billion, 117 billion. Last 12 months, again, revenue has grown, but at a slower rate year-on-year. But their profits, as you can see, the net income at the end of the day has been growing, except for the last 12 months, it dropped to 28 billion. So people are freaking, oh my God, their profit is dropping. Now they're still making money, it's just that they're making less money. So reason is because of their expenses. Their operating expenses or OPEX, look at that, it's been increasing. 28 billion, 36 billion, 48 billion, 59. Oh my God, what the heck are you spending on? What the fuck, suck? Right? So if you take a look at their expenses, most of the increase in expenses is coming from the culprit, ta-da, R&D expenses, and of course some administrative expenses. You can see the R&D expenses from 10 to 13 billion has been going up like crazy in the last 2 years to 18 billion, 24 billion, 32 billion. And they said in their conference call that they expect their expenses to go up even more in 2023. So if their revenue doesn't grow that fast next year, expenses go up even more, their profits could turn negative. And that is what's freaking people out. Oh my God, let's sell, let's get out right now. So let's understand, why are their expenses increasing so much? Is it within their control? Okay. Now, a lot of people think that their increase in expenses is because they are betting very heavily on building the metaverse, that people are very concerned about because it's a new thing that's not been proven and very high uncertainty, it may not work out. Now, while it is true that they are spending a lot to build the metaverse, which is still unprofitable, they are losing something like about 4 billion per quarter on the metaverse expenses. So 4 billion per quarter, it's about 16 billion a year, which is quite a lot of money, right? But the main increase in the expenses is not metaverse expenditures like what people think. So what is it? Let's take a closer look at the reason, okay? Now, by the way, these are quarterly figures, and you can see, this is the latest quarter. Their net profit, you can see, dropped to 4 billion, and it's been dropping for the last 2 quarters, from 7 billion to 6 billion to 4 billion. So that's, again, scaring people. Profits are dropping, and again, why? Because, again, quarter on quarter, look at the operating expenses. Expenses going up 13 billion, 15 billion, 16 billion, and it's all coming from their R&D expenses. Look at R&D, right? 7 billion, 8 billion, 9 billion. So people think that Zuck's gone mad, his costs are out of control, he's overspending, he's spending on shit that may not work out. So that's what they say, but if you dig deeper, you realize that not really. Let me show you. So again, quarter 3, their total expenses were $22 billion. Expenses up 19% compared to last year. Why? Because R&D increased 45%. And this increase in R&D is mainly driven by hiring within our family of apps and the Reality Labs segment, as well as Reality Labs technology and development cost. All right. Now, in quarter 3, their family of apps expenses were 18.1 billion. Now, family of apps refers to their legacy business, which is Facebook, Instagram, WhatsApp, and Messenger. So you can see that it is their legacy, their current business, that represents 82% of their overall expenses and their increase in expenses. So it is not the spending on the metaverse, although that has gone up as well. All right. Family of apps expenses grew 18%. Why? So where is it coming from? It's driven mostly by employee-related costs, infrastructure-related cost, and impairment for certain operating leases for office facilities that we plan to exit. So in other words, they are renovating their office, but of course that's one small thing. But they're spending a lot on infrastructure, on building data centers, so on and so forth. Okay? So the question is this something that is long-term, that they have to build new infrastructure every year going forward? Or is it like a one-time thing that once they build this infrastructure for the next 2 years, they are set for life? Once they move office, they downsize, more efficient, they're set for life. I think it's the latter, right? It's a short-term spike in expenses to set their growth for the long run. Okay. Now, having said that, Reality Labs, which is their metaverse expenses, is also up. Okay. Reality Labs expenses were $4 billion for the quarter, up 24% due primarily to employee-related costs. So a lot of it comes from inflation of wages, right, and technology development expenses. Reality Labs' operating loss was $3.7 billion. So besides the increase in operating expenses that is reducing their profits in the short term, the other thing that investors are concerned about is Meta's increase in capital expenditures. So again, when you increase your capex, that lowers your free cash flow, which means you have less money to pay future dividends or to buy back shares. So you can see over here, quarter on quarter, their free cash flow is usually about 10 billion per quarter. So they're generating about close to 40 billion in free cash flow a year. But their free cash flow has been falling from 12 billion to 8 billion to 4 billion, and the last quarter, their free cash flow is only $173 million. So there's concern that free cash flow could go negative in the next few quarters because they are spending heavily on their capital expenditures, their capex. You can see their capex has grown in the last 2 quarters from 5 billion to 7 billion to 9 billion. Now, we don't like companies that spend too much on capex, because when you spend a lot on capex, it reduces your free cash flow. But what kind of capex? Now, there are 2 kinds of capex. There's what we call maintenance capex, and there's growth capex. So I don't like companies that spend a lot of capex to maintain their business operations, like airlines, like shipping, like real estate, because they have to spend a lot of money to maintain their business, like auto manufacturers. Okay, but when a company spends capex to grow their business, that's fine, because the capex is used to generate future revenue growth. So in the case of Meta, for example, is it growth capex or is it maintenance capex? It is growth capex. It is mostly growth capex. And where is the capex coming from? Again, people think that it's all the metaverse. He's betting all on the metaverse, right? No. Okay. So if you read the earnings call transcript, you can see that Meta is currently going through an investment cycle. So remember, all businesses, they go through a period where they have to invest heavily short term for the future growth. Okay. And it's being primarily driven by two areas. Number one, they are investing significantly in their AI capacity, their artificial intelligence discovery engine. These investments are driving substantially all our capex growth in 2023. So it's up to 2023 next year. It requires more expensive servers and networking equipment, and we are building new data centers specifically equipped to support the next generation AI hardware. We expect these investments to provide us technology advantage and unlock meaningful improvements across many of our key initiatives, including feed, reels, and ads. Number two, we are making ongoing investments in our data center footprint. In recent years, we have stepped up our investment in bringing more data center capacity online, and that work is ongoing till 2023. We believe that additional data center capacity will provide us greater flexibility with the types of servers we purchase, allows us to use them for longer, which we expect to generate greater cost efficiencies over time. These investments, along with revenue headwinds, are contributing to higher capital expenditures as a percentage of revenue in 2002 and 2003 than we expect over the long run. So in other words, what they're saying is this, right? Their increase in capex is for the short term, the next 2 years, that will reduce their free cash flow, but it's to build their AI capacity that's going to make their engagements, the stickiness of their products even stronger, to widen their moat. And of course, to build up their infrastructure, so in the long term, their servers, their data centers last longer and become more cost efficient. So is this a problem for the business? And is this a dying business? It doesn't look that way, right? So again, the increase in expenses, the increase in capex, number one, is within their control. They can reduce it anytime, and they will reduce it after 2023. Number two, they are doing it in order to increase their competitive advantage and to become more cost efficient in the future. So this is very much like what's happened to Amazon and Adobe, which I own shares in as well. Now this year doesn't seem very nice because the share price of my favorite companies have been falling significantly, but I'm not at all concerned because it's the same case with Amazon and Adobe. They are both extremely strong businesses, but they chose to spend very heavily this year on capex. Like Adobe spending $20 billion to buy Figma to grow their future revenue. Amazon spending billions of dollars to build their fulfillment centers, to become even stronger in their stickiness with their customers. So all this is leading to drop in short-term profits that investors don't like. So they're selling the stock, dropping 20, 30, 40%. But in the long run, will it benefit the company? You bet. In the long run, it's going to lead to a stronger business. Okay? And so when a company increases expenses in the short term and profits drop in the short term, that's not a concern, because once they end their investment cycle, once they start to say, okay, we're done, we've invested all we need to invest, we've spent all we need to spend to build, and that falls, revenue will then grow again, explode again, right? So it's kind of like what's happening in my life right now, okay? Now, by nature, I'm a very frugal person. I don't spend that much money, although I earn quite a pretty good income, right? Now, I've been living in the same house that I bought 16 years ago, by the way. And this year, my wife and I, we decided to renovate our house. We thought, you know what, it's time to renovate. Our kids are growing older. We've got more needs and so on and so forth, okay? And so I just moved out of my house into a rental house while we renovate our house for a year and a half. So I'm spending roughly about $2 million to renovate my existing house. We are building a third floor plus an attic. We are putting in a lift. We are putting solar panels and so on and so forth. So because of that, I'm spending a lot of money in the next 2 years. Okay, that obviously will reduce my savings in the next 2 years. But it's short term. And the reason I'm doing it is because by building the third story and solar panels, in the future, it makes my life more convenient. It gives me more growth, right? And helps me to reduce more expenses because of solar panels and so on and so forth, right? So it's the same thing with the business, all right? So as an investor, you gotta see when you see profits are falling. Why are they falling? If they're falling because the business is in trouble, sure, sell the stock, get out, not worth staying around. But if again, profits are dropping because expenses are increasing, and the reason expenses are increasing is because of development R&D work, because of growth capex, then to me, that's a good thing, not a bad thing. But the market is emotional, the market is short-sighted, they panic sell when they see falling profits, when they see moderating revenue. Is that an opportunity to build a bigger stake in a great business at lower prices? I leave that to you. So moving forward, what can we expect? So Meta is saying that for this year, they expect their capex to be 32 to 33 billion, which is about the same as what they said the previous quarter, right? Now for next year, 2023, we expect capex to be in a range of 34 to 39 billion dollars. Again, driven by our investments in data centers, servers, and network infrastructure. So 34 to 39 billion dollars next year. Is that a lot? Let's take a look. So you can see that their current their cash from operations for the last 12 months is 54 billion. So if they intend to spend 39 billion in capex, which is an increase from 27 billion, their cash flow should still be positive. But there is a concern that if their cash from operations falls because of the slowing economy and a recession, and their capex goes up to 39 billion, they could become free cash flow negative next year. And that could really freak people out. All right. So what I'm saying is this: is there a chance that the stock price could go down even more in the next 1 year? Yes, there's a possibility because of their heavy investments. And if revenue doesn't re-accelerate fast enough in the next 1 year, share price could go down in the short term. But I'm not too concerned because, like I said, it's a short term. If you look, 2, 3, 4 years out, once revenue re-accelerates, when the investment cycle is done, they will then see a huge rebound in their profits, free cash flow, and obviously the stock price. All right. So if you're in it for a short-term jump, I'm not too sure about that. But in the long run, to me, it's a business that has a strong future. Right. Whether or not the metaverse thing works, to me, that's a bonus. Now, in the short term, in the next 1 year, there could still be a lot more downward pressure on the stock because we don't expect a rebound in revenue and a drop in expenses anytime in the short term. We expect it only after 2023. So you got to be aware of that, right? So the company said that we expect our revenue for fourth quarter to be 30 to 32.5 billion, which is still very soft, which is below analyst expectations. And that's one reason why the stock sold off, because of lower forward guidance. And they said, yes, we have increased our scrutiny in all areas of operating expenses. So they're saying that, yes, we are looking to manage our expenses better. However, these moves follow a substantial investment cycle. So it happens to be that they are just in this investment cycle where they have to spend a lot right now, like me renovating my house, for a better future, right? So it will take time to play out in terms of our overall expense trajectory. This will lead to incremental costs in the near term, but set us up well for the future years when we expect to return to higher rates of revenue growth. We expect 2022 total expenses this year to be 85 to 87 billion. Yeah, that's very high. I've got to say that, right? Updated from our prior outlook of 85 to 88 billion. We anticipate full year 2023, which is next year, to be in a range of 96 to 101 billion. Okay. I have to admit, when I saw that, I got concerned. Yeah, so expenses next year expected to be 96 to 101 billion. Okay, so what does that mean? That means that if their expenses are 100 billion, okay, that is very close to their revenue. Okay, So in other words, in 2023, they may not make any money. They may lose money in 2023. Their free cash flow could go negative in 2023. So investors are concerned about this, and that's why they are panic selling. All right. So in the next 1 year at least, like I said, there could still be a lot more downward pressure on the stock because of that. Okay. However, good news. We expect the percentage of growth of operating expenses to decelerate meaningfully after 2023 as we curtail non-headcount related expense growth and keep 2023 headcount roughly flat with current levels. We do anticipate that Reality Labs, which is their metaverse operating losses in 2023 to grow significantly year over year, but beyond 2023 we expect to pace Reality Labs investments such that we can achieve our goal of growing overall company operating income in the long run post 2023. So in summary, don't expect revenue to increase substantially or expenses to go down for the next 1 year, right? Profits could be negative next year, free cash flow could be negative next year, stock price could still go down in the short term for the next 12 months. But beyond the short term, in 2, 3, 4 years, the stock can easily double and triple because once revenue re-accelerates, once they reduce their capex, profits are going to surge again. Free cash flow is going to be very, very high again, right? Now, again, this is not taking into account their metaverse, assuming that doesn't work, right? So if the metaverse takes off, and that's another huge revenue stream that they can control, then you're looking at more than a 10 or 20x for this company. So that's a bonus that I don't think about as an investor, all right? So ultimately, if you're in it for the very short term, you're looking for a short-term increase in the share price, I don't know, right? May or may not happen, okay? But patient investors with a view on the longer term, I believe are going to be well rewarded. You know, in summary, when I own the stock of a business and the share price goes down in the short term, do I sell or do I hold and buy more? I ask myself 4 questions. Number 1, is it still making money? If it's making money, cool. Even if the profits are kind of like decelerating, but if it's still making money, it's fine. Number 2, is the company financially strong? Do they have a lot of cash on their balance sheets? Do they have relatively low debt? And the answer is yes for Meta. They are financially very, very strong. A lot of cash, relatively low debt. All right. Number 3 is the most important thing. Do they still have a sustainable competitive advantage? Are they still dominating within their industry? Are their products getting more and more sticky? Are they getting stronger with the consumers? Answer is yes, right? User base is increasing, engagement is increasing, more revenue streams are coming online. The 4th question is this: is the company share price selling a lot less than what it is worth? If it is, I'm happy to hold it because I know there's a lot more upside once the price re-rates to the true value of the business. So at the current price of $98, is Meta stock cheap or expensive? Let's take a look at a few ratios and I'll do an intrinsic value calculation. So if you look at the PE ratio right now, price to earnings ratio, it's selling at 8 times PE. Forward PE is slightly higher because they expect, again, a short-term fall in profits next year because, again, increasing expenses. Forward PE is 9 times earnings. So that's pretty low for a company like Meta, right? That's in a long-term secular growth industry. Is P high or low? Well, you have to compare it to the growth rate. So their projected growth rate for the next 5 years is 6.8%, which is a very low estimate because think about it. The last 5 years, they grew at 31% a year. And now analysts have reduced their estimate to only 6% for the next 5 years, which to me, I think eventually they would surpass that. But even at 6.8%, at a P of 8, that gives you a PEG ratio of 1.19, which is pretty reasonable. Now, let's do an intrinsic value calculation on Meta, right? So I'm using a discounted free cash flow, and I'm using free cash flow of 39 billion, which is their normalized free cash flow. Okay, so I won't take the recent ones because it is distorted by short-term higher capex. You see, when you value a business, you have to think about the free cash flow they're going to generate in the next 20 years. I'm using a 20-year calculator. So I'm using what I call normalized free cash flow. So if you take their operating cash flow for the last 12 months, deduct their normalized maintenance capex, you get about 39 billion in free cash flow. That's their normalized free cash flow, right? Their total debt is about 14 billion. Their cash on hand is 41 billion. So again, they are very cash rich, financially very strong. And we just take a 6.8% growth for the next 10 years. And then growing at 4% thereafter, which is the GDP growth rate of the economy. So I'm taking very, very conservative projections. They've got 2.7 billion shares. I'm using a 7% discount rate for a 20-year projection. So that gives me an intrinsic value of $276. That's what the shares are worth based on this 6.8% projection, right? So at the current share price of $97, it is 64% undervalued. So you're buying something at a 64% discount. If you ask me, it's very hard to lose money when you're buying something at a 64% discount, something that is growing, something that is financially strong, something that has huge potential in the future. Now, I like to do kind of like a worst case scenario, right? So what happens is if they never grow again, if their growth rate becomes 0, which is improbable, all right? But let's say if they never grow again, right? In a 0 growth rate, the business is still worth $163, which means it's still selling a 40% discount, even if they never grow for the rest of their life, okay? Which is very, very improbable, right? But if they grow at, again, 6.8%, which is a reasonable projection, and then tapering off to about 4%, which is the GDP growth rate of the US economy, plus 1%, they're worth $276. So as of yesterday's closing price at about $97, it's way below the intrinsic value of $276. So there's a huge margin of safety for this stock. Now again, that doesn't mean that the stock can't go lower. Remember that in the short term, the market price is not logical. It's not based on the fundamentals of the business. It's based on purely news, emotions, high frequency trading, and sentiment, right? So sure, it could still go lower, especially if the downtrend prevails. This is what we call the downtrend, okay? So if you want to wait for the change in the trend to add more shares, you could do that, right? You could wait for higher highs and higher lows, wait for the 50 moving average to cross back above the 150 moving average, or wait for it to cross back above the 200 moving average, wait for moving averages to slope up to then, add more shares in. You could do that. But of course, by doing that, you will be buying at higher prices. So ultimately, as an investor, if you're someone who looks at the long run and you don't care about short-term volatility, you could add shares right now. But if you're someone who wants to confirm the trend on the charts and enter only at higher prices, that's fine as well. It really depends on your approach to investing. So hope this has been useful, and I'll see you guys in the next video.